Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sonal Bhutra. And Sonal, it's been a quiet start to the month of December, right? Absolutely flat on the benchmark indices, though the broader markets are very active. The mid-cap index is up close to about 3/4 of a percentage point. The small-cap index is up nearly 7/10 of a percentage point. In terms of sectors on the way up, it's realty doing very well, and we've got a new IPO which is opening. So that we'll discuss that. Pharma is higher in trade. Auto is okay, led by names like Maruti Suzuki, which has reported a double-digit revenue growth, about a 10.5% increase in the company's November sales. So Maruti Suzuki is the big winner in the auto pack as it moves up close to about 2%. And PSU banks have taken a bit of a backseat.
Oh, yes. And, after that GDP data, which came in as a shocker, there were a lot of discussions, maybe that this could impact markets. This is not the slowdown that was expected, but largely the street has been able to get over that. Nifty is very quiet, actually. It's 11-point downtick, but we started on the back foot. It was a bigger cut, and we have seen recovery from those levels as well. The mid-caps are doing really well. And the forward-looking macro data in terms of the November auto sales, that's looking up. So maybe that's the thing that markets are focusing on right now, that what could quarter 3 look like, what could quarter 4 look like, and that is something that the street is focusing on right now. Couple of stocks which are on my radar today. Look at something like a Biocon. That stock is up around 4% right now. IGL is the other one, and remember IGL, MGL, they were at 52-week lows after the recent change in this gas allocation bit, and since then brokerages have become quite bullish on the CGD space because of valuation comfort, and that's the reason why we're seeing that uptick. Both these stocks are at the day's high as we speak. The other names include something like a Varun Beverages. That stock is up 3.5%. Zomato is also seeing some gains. It's up around 2%. So these stocks have been doing really well. From the broader market, some of the less spoken stocks, something like an Ami Organics, it's reported what was a strong quarter 2. They in fact increased their guidance as well, and that stock right now is seeing gains of almost 7%. So watch out for that stock as well. So some of these broader market movers is something that you should be aware of as well. But let's talk about a confirmed news break by CNBC-TV18. Aster DM Healthcare has announced a merger with Care Hospitals. Winnie is here with the details and what brokerages are making of this move. Winnie.
Absolutely. So this is a very big positive news that's come in for Aster DM. And like we were saying also, this is an CNBC news break that is confirmed. So it's good up move in the stock. Aster DM Healthcare and Quality Care India signed a definitive agreement, and this came in as a news on Friday afternoon post-market hours. Now, this merged entity will be among the top 3 hospital chains in the country, so they have a big scalability that comes in on that front, and gives them a further opportunity to expand further greenfield options, brownfield options as well in terms of expansion in the central as well as south of India. This is a EPS accretive business for them. So yes, margins are also going to see an improvement coming in. Aster DM margins, what we expect for the merged entity is going to be at around 20-21%. So much better than what is the current Aster DM margin, as well as the return on capital employed is expected around 18%. Currently for Aster, it's at around 16%. So yes, the share swap that is there for every 1,000 shares of Quality Care, the shareholder will be getting 977 shares of that merged entity of Aster. So keep an eye out on that. Brokerages are also positive on this one. Axis has raised the target price to 575 rupees from previous 510, and Laura Capital maintaining the rating and a target price of 521 rupees per share.
When we look at our margins right now, EBITDA margins around 17%, it actually moves up to 19% in a post-merge scenario. So, which is why, exactly like you said, it's EPS accretive from day one. This merger, it values the entire deal at more than $5 billion. So we believe that this is one of the largest healthcare transactions this year. So we should be able to see the additional 10 to 15% EBITDA margin expansion, maybe in sort of 2 years. 24 months to 36 months is when you really start unlocking those synergistic opportunities, to be honest. Aster has been outperforming its peers, and we have been growing much faster than most of the peers in the industry. We expect at a combined level, we'll still be able to be close to 20% CAGR. I think what has happened also is since Blackstone has come in, there's been a lot of investments that they've been making in terms of infrastructure upgrade. So I think there's been a little bit of a delay in some of those investments paying off. But at a combined level, we expect that we should be able to do still a 18-20% revenue CAGR over the next couple of years.
The street giving a thumbs up to Aster DM. One, it expands their overall bed capacity to 10,150 beds, and the company said that they're planning to add another 3,500 beds in the next 3 years. So that's one. Two, Aster DM was geographically concentrated more in South India, and now with this merger, they also get big in Central India, particularly Gujarat. And the third thing is it also changes the profile of customers. So Aster DM was present more in oncology, but Care Hospitals was known for its cardiac facilities. So in terms of offerings, customer offerings, it also expands it quite significantly, and the street likes this. But moving on to electric two-wheelers, they're in focus now. Sudarshan joins in with the numbers now, the updates, and who's won market share and who's lost market share. Sudarshan.
So we have Vahan retail registration data, and we have analyzed those data, and it indicates a sharp drop in the market share for Ola Electric against the last month, that is against October 2024. In the month of November, Ola Electric's market share has fallen 500 basis points, and now it stands at 25%. So the question is, who has gained? So in front of Ola, the gainers are TVS Motor and Bajaj Auto. TVS market share now stands at 23%, which is up 100 basis points month on month, and for Bajaj Auto, market share now stands at 22%, which is up 200 basis points month on month. Even the sales indicate a drop for Ola Electric. Ola Electric sales were down 2% year on year and down 30% month on month, while for TVS Motor, sales were up 41% year on year, but was down 10% month on month. For Bajaj Auto, sales have increased 120% year on year, but on month, it was down 7% against October 2024. Now, if you take a look at the market share since the beginning of FY25, in April 2024, Ola's market share was at 52%. So basically, it is half, and now it stands at 25%. For TVS and Bajaj Auto, both market share for both the companies were 12% each in the month of April, and now for TVS, market share is 23%, and for Bajaj Auto, it's at 22%. So it indicates that despite the several launches in the last few months, Ola continues to lose market share in electric vehicle segment.
Okay, all right, continues to lose market share. Thank you so much, Sudarshan, for joining us with those important details. The stock continues to be on our radar. We'll slip into a short break now. Stay tuned as management of Property Share will join us next on the back of their upcoming IPO, which opens today. It is the first in this SM REIT category. We'll talk about it in greater detail. Okay, all right, welcome back. You're still tuned into Trading Hour on CNBC-TV18. The markets have recovered a tad bit, but it's time to talk about commodities. Manisha Gupta is joining in now, and we are focusing on gold. What's happening here, Manisha?
Well, a big amount of profit taking is what we've seen in the month of November. And with that, the month of November actually has been the worst month in last 14 months, really. We have seen 2% of a decline in the gold prices in the previous week. It's declined by 3% for the month of November as well. And with that, we've sharply come off the all-time highs that we were trading into the market with. Well, we did see an all-time high of around 2,780, and we're trading at around $100 down from those kind of levels. This is also because the dollar index has gained quite strongly. It is up 2% for the month of November, holding above that 106 mark, and that has been weighing on in case of gold. Well, the strong US dollar also post Trump's win has weighed on, and then Trump has threatened almost 100% of tariffs on BRICS if they are looking at other currencies therein. Strength in US dollar in any case does mean gold prices continuing to decline. Most of the dollar denominated commodities, by the way, have reacted like that. The other thing also is about markets looking at probability of around just about 60% of chance of a 25 basis point rate cut in the month of December, and 2 perhaps in 2025. That also does not augur so well for gold, is the reason we've seen a decline coming in. Also from the Trump statements now, whether or not and how much will many of these global central banks add gold as their forex reserve is something that is under a bit of a question mark as well. So as markets analyze that, digest that, we have seen some more profit taking come in for this one.
Thank you very much for that. We will slip into a very short break. On the other side, we'll discuss market technicals. Soni Patnaik of JM Financial Services will join in on the other side. Welcome back. In the green now, it's 24,150 on the Nifty. Reliance Industries is back in the green. Bajaj Finance, it's trimming some of its cuts. ITC too is trying to get back in the green now. You also have Infosys. M&M is started inching up. And Dr. Reddy's is currently your top Nifty gainer with a not the top Nifty gainer, I'm sorry, but it's been one of the movers, 1.5% higher on Dr. Reddy's. But let's get to the big macro story. Now, the second quarter GDP number came in at 5.4%. Yes, the street was expecting muted numbers given the weakness in urban consumption, the lack of government spending, but at a 5.4% print, it was much lower than consensus expectations. Now, this makes the RBI meet on the 6th of December very interesting. Will we see a repo rate cut or a CRR cut? Lata has just concluded her Citizens Monetary Policy Committee. She comes in to weigh in on that and what it means for the banks. Lata.
Yes, that's right. At 5.4%, it's such a shocker. It's expectations are normal that the Reserve Bank has to do something. And that, its priority is inflation, keeping CPI at 4% plus or minus 2. But now growth also becomes a priority, maybe even a slightly higher priority. As it is, we know ministers like Piyush Goyal have been saying that a rate cut is called for. Now, what economists say is, how can a Reserve Bank whose mandate is 6% inflation do a rate cut when the last inflation number is 6.2? And for all you know, November also will be close to 6% CPI. It's hugely going against its own mandate. And so is there a chance that they will actually lose in liquidity? Repo rate is the price of money. Liquidity is the amount of money. So a CRR cut can increase the liquidity. Now, let me tell you what the impact on banks can be. Repo cut. If you cut the repo rate, then there can be a negative short-term impact on banks because under new rules after 2012 or thereabouts, the interest rate, lending rate is linked to an external benchmark. It's called EBLR, external benchmark lending rate. So, home loans, corporate loans are all linked to either the repo or the T-bill, one of the external benchmarks. If you cut the repo rate, then all these loans will earn the banks less. But the cost of money, which is deposits, will go down slowly. So immediately, there will actually be a negative impact on bank margins. When liquidity is tight, a repo rate also is less effective. But importantly, for the banks, it is a short-term negative. Let us look at what happens in a CRR. What is the CRR? It is that part of your deposits which you cannot lend, which you have to keep idle as cash. At the moment, for every 100 rupees, 4.5 rupees CRR of 4.5% means 4.5 rupees cannot be lent. It has to be kept idle. But that money is being raised at 8% or something as an FD or whatever by the banks, but it's not earning anything. Suppose that comes down to, say, 4.25. Then a 0.2, now what is actually being released that you can lend? 0.25% of the total deposits in the system, which is 230 lakh crore. So 0.25% of that is something like 57,500 crores or thereabouts can be lent. It was earning 0, it will now earn something like 10%, 11%, depending on what loan you're giving. That means margins for every 0.25% cut in CRR can increase by about 2-3 basis points. If it's a 0.5% cut, then it can increase by 5 or 6 basis points margins. I mean, that's just blanket. Everybody's margins improve. Now, this is the first shot. Every time you give, a deposit has a multiplier. It's called the money multiplier. For instance, we get our salary from the company. It shifts from their deposit to our deposit. An additional CRR instead of 4.5 will become 4.5, 4.25 or 4. Then I pay my child's school fees. That goes to another deposit. Again, a further 4.5 has to be kept. No, now they have to keep only 4%. So there is that is called the multiplier effect. So the ultimate impact on banks over 6 months can be more. That's the basic thing. For banks, repo is slightly negative in the near term. CRR is positive in the near term and in the medium term.
Okay, all right. Thank you so much, Lata, for joining us and explaining to us what this could mean and what could the outcome be in the RBI Policy Committee. We'll be waiting for the analysis as well. Fridays when you can tune into for all the updates. But let's move on and continue talking about markets as well. Soni Patnaik from JM Financial Services is joining us now for a quick technical check. There's been a definite recovery from the lows. The markets are in the green now, Soni. What are the next important levels we'll be watching out for and your individual technical picks?
Hi, good morning, Sonal, Rima. Thank you for having me on your show. I think for Nifty, it is in a sideways trend, and fresh upside for Nifty can only be seen if it crosses the 24,350 mark, which is actually the current level of resistance. So only above that move, you can see it heading towards 24,500, 550 odd levels. On the downside, 24,100 plays a very important role on intraday support. Even if that breaks, you've got multiple other supports around 24,000 to 23,950 range. So I think these supports are going to get defended. It may remain sideways. And, after DO2, you can see the move happening on the upside as the data shows that the put writers are getting quite aggressive on the lower side. So they are about to defend those, support levels. It is important. We can wait for a while and let the break happen above the 24,350 mark. So I think that's for Nifty, and similarly for Bank Nifty, it's in a very broad range between 51,500 to 52,500. A weekly close above 52,500 in Bank Nifty can see the next level of upside rally towards 53,500 odd levels. So as long as 51,500 gets defended in Bank Nifty, one can hold on to the longs in Bank Nifty and look for higher targets. It's just a matter of time before it breaks above the resistance. If we talk about the individual stock ideas, I've got two buy ideas for the day. The first would be in Jubilant Food. Now, Jubilant Food has seen a very strong long rollovers of 93% for December series, and it is just approaching a consolidation breakout level. So one can accumulate Jubilant Food and on small declines till 650 odd levels. Keep a stop loss of 640 and look for higher targets of 680 to 685. The second buy idea is in Sona Comms, which is also a new entrant in F&O space. Sona Comms is currently breaking above a 20 EMA hurdle on intraday charts, looking quite strong. It has given a fresh breakout. Also, one can buy Sona Comms with a stop loss of 665 and a target of 710 to 720 can be seen.
Thank you very much for that. By the way, look at RBL Bank. RBL Bank is almost now back in the green from the day's low. It's recovered close to about 4.5%, 5%, and that just gives you a sense of the kind of market. There's been a pickup in RBL Bank. We will get into a break. On the other side, we'll invite Mr. Parag Thakkar, Senior Fund Manager at Fort Capital. Stay tuned.
CNBC over the years has played a very important role in communicating what is happening in India, what is happening across the world, to people interested in the economy, to investors, all stakeholders of the financial world. And I think this role of playing a bridge between reality and international situation and making investors informed investors is truly a commendable contribution. 25 years is a long period of time. The credibility that CNBC-TV18 has gained in these 25 years truly makes all of us proud and helps also have a very organized growth of the economy.
Welcome back. Well, the government has proposed amendments to the Insurance Act that would allow agents to partner with multiple insurers across life, general and health insurance segments. Let's go across to my colleague Yash to understand the dynamics and how this will impact LIC. Yash.
Well, Sonal, very recently, as you pointed out, the government brought out the proposed amendments to the Insurance Act. There are many, many interesting things which are a part of these proposals. One of those is allowing individual agents to tie up with more than one life, one general and one health insurance company. The current regulations restrict agents to tie up with single life general and health insurance company, but the government has proposed to introduce an open architecture there through which these agents will be allowed to tie up with more than one life, one general and one standalone health insurance company. Essentially, this proposal on the face of it right now seems to be negative for the largest life insurance company, that is LIC, because LIC derives a large portion of its business through individual agents. To be precise, more than 96% of the business for LIC comes through agents. More than 50% of the total industry agents are with LIC at this point of time. And if these agents are allowed to tie up with more than one life insurance companies, then it certainly could be a negative for LIC. There's one little caveat here. Of course, stakeholder views on this particular proposal are expected by December 10th. If this goes through, then the regulator will have the authority to frame regulations on allowing these agents to tie up with multiple life, general and health insurance companies. And the government has said that these regulations should be formed keeping in mind that there is no conflict of interest. But certainly on the face of it right now, negative for LIC when it comes to this part of the proposal.
Thank you very much for that. We've got Parag Thakkar from Fort Capital joining us on the show. Many of you would recognize him as the face behind ICICI Pru and some of their funds. Parag, thank you very much for joining in. So first, let's straight away get to the GDP print, right? It came in as a bit of a shocker, but markets appear to be taking it in the stride now. We're back in the green.
Yeah, because actually everyone who has spoken to the companies during this period of last quarter and who has seen the numbers, he will not be shocked with this number.
It was bad
because it was really bad. You know, where have you seen the paint companies and FMCG companies showing negative growth? You know, so all this, and I think it's a self-applied break by our government. Election, heat wave, monsoon, and of course RBI tightening on so many fronts, like MFI stress, and rightly so. So I think all this has come together. So when Nifty was at 26,000, we raised a lot of cash. Even today, we are sitting on 10 to 15% cash level across the portfolios, because we felt that market was running ahead of itself at 26,000 Nifty, because September quarter's results were going to be bad. But now from here on, I would say that this is a bottom. Because, for example, festive season demand has picked up a bit. We have a longest marriage season, November to Jan, which will boost consumption to some extent, and government spending will also pick up by March. So I would say that in April we should be talking a different story. So this is a good time to deploy money on every dips. Plus, I would say that on Friday in RBI meeting, definitely we'll see some sort of liquidity infusion, which is durable liquidity, which will stabilize the market.
It'll be very important, the RBI commentary as well, right? After
Absolutely.
These numbers. And as you said, now the demand is looking up, and whatever was done in quarter two in terms of weak earnings, so the first half, that is something that was self-applied break, so to say. But going forward, Parag, what are some of the picks? If you are saying 10 to 15% cash, but now cash should be deployed on every dip. You like HUL. It's the consumption name, the consumption theme didn't do so well.
Perfect.
What are you liking here, and versus other peers, how do you like it?
I'll tell you, first of all, Unilever growth officer coming in India and saying that India is their heartbeat. That gives me a great comfort that their focus is on India. Of course, 11% of their revenues comes from India. The other thing is they have underperformed so much since last 4 or 5 years. If you see, after that block happened of 25,000 crores. And plus, they are saying in their capital market, they have said they are aspiring for double-digit EPS growth based on led by revenue, led by top line and volumes. So, and plus they have huge opportunity to grow and upscale. and premiumize the beauty and wellness category, right? Because in India, the premiumization is a core play, right? And Lever is a good play in beauty and wellness segment. And plus, I think, say, multiple wise also historically it has traded 50 to 55x. Today it is trading at 40 times FY27 earnings of 60 rupees. So we would say that 25% upside looks great. First of all, the disclaimer that we own that in our portfolio. And apart from Lever, for example, Larsen. Now, Larsen is also a large part of our holding. We have seen government spending lagging, right? That is the core reason behind this GDP thing. Now, government spending has to come back. So you have to, at the bottom of the cycle, Larsen or cement stocks, for example, today cement stocks are looking up, right? Because we have hit the bottom there. Same way for ICICI and SBI, I'll cover it. These are the banks which have comfortable CD ratios, strong deposit franchises, stable asset quality. Credit cost is 50 bips only for both of them. ICICI is a steady compounder with 15% growth. And SBI has also set at 14 to 16% growth. SBI's last year's, if you see FY24 standalone PAT was 61,000 crore. The chairman has said on media saying that 3 to 5 years, this PAT will double to 1 lakh crores. From 61,000 crore to 1 lakh crore. So it is 12 to 13% EPS CAGR in a large cap company like SBI, which is trading at only 7 PE on FY27 and price to book is just 1.1x on FY26, while actually they are doing a ROI of 1.2 and ROE of 16 to 18%. So they should get 1.3, 1.4x in my view. So in the next 18 to 24 months, you can see 25% upside over there also.
HDFC Bank was the darling of investors, right?
Absolutely.
But you're saying SBI and ICICI Bank would be preferred.
No, I'm a big believer of HDFC Bank's DNA. I have gone on public many times saying that this is a temporary problem. The only thing is that because they have to bring down the growth load because of the CD ratio issue. Of course, they have brought down CD ratio from 110% to 100% very nicely, quickly and rightly so. And they are going to bring it down in another 6 to 7 quarters. You will see them at 90% in terms of CD ratio.
But you think till then, for the next 1.5 to 2 years, HDFC's bank's growth will be slower than peers?
Growth will be slower, but I think that is known to market. And their asset quality is pristine. There is no problem in their asset quality at all, right? So the only thing which I would monitor in HDFC Bank is margins. Because when you bring down your growth so much, and of course, you are not lending to riskier segments, right? That is where SBI has a very high liberty because SBI's CD ratio is only 69%.
And it has been outperforming.
So if suppose private sector capex picks up, if government capex picks up, SBI is there to lend. They also have a 6 lakh crore pipeline, right, in corporates to lend to. So because of the lower CD ratio, they can participate in that capex cycle led by government as well as private sector if it comes back.
And that's the hope, right? In the second half, at least, the government capex cycle, that would improve versus first half. And if there's private capex as well, it could prove positive for SBI. Parag, a pleasure speaking with you today. Thank you so much for joining in and telling us what all you like in the markets. And yes, maybe it could be the bottom and we could look up from here. So that's the market and fundamental conversation. But it's time for a short break. When we come back, we'll talk more on the markets on the other side and a lot of stock-specific action as well. Stay tuned. Welcome back. You're still tuned in to Trading Hour on CNBC-TV18, where the REIT IPO of Property Share Investment Trust, India's first registered small and medium real estate investment trust, has opened for subscription today. The issue will be available for bidding till December 4th. Hashim Khan, the co-founder and director of Property Share, joins us now to take a few questions. Mr. Khan, good morning. Thank you so much for joining in. Well, can you explain the structure here? Give us a sense of the structure. How many projects do you have under the trust? Is it just one project that you will be acquiring right now? Do you have plans of acquiring more projects? How would it work?
Good morning. Thank you for having me on the show. This is a new regulation that SEBI came out in March this year, which is the SM REIT regulations, a new chapter under the REIT regulations. The way it will be structured is that there is a trust which has the license for the SM REIT. That trust can launch multiple schemes. Each scheme has to be between 50 to 500 crores, and the scheme will then go and acquire properties from the market. Unlike REITs, where the minimum issue size has to be more than 500 crores, the 4 REITs that are currently trading in the Indian markets are more than 300 crores, 3,000 crores issue size. These are smaller concentrated bets with one or a few properties under each scheme. The trust will launch multiple schemes. PropShare Platina, the scheme that is currently open for subscription, is the first scheme launched by the trust, which is the first license that SEBI gave under the SM REIT license.
Okay, so this will be just one property or one building that you will be acquiring under this REIT, and going forward there could be plans of acquiring more. So this one, under different scheme, but under the same name.
353 crores. The maximum size of any scheme under SM REITs has to be 500 crores. So new scheme will have another property.
Okay, new scheme will have another property. Got that. So under this property, I just wanted to confirm you've already bought it in November, right?
No, we propose to buy it.
Okay, you propose to buy that, and this will be via the funds that you'll raise in this IPO.
Yes.
So what would the annuity look like? Because you've not bought it yet. What are the financials that you are guiding for going forward, and what will the yield look like on this particular property?
So the first year's yield would be 9% pre-tax and 8.2% post-tax. Second year, it would be 8.7% pre-tax, and third year, it would be 8.6%. It drops a little because our fees for the second year is 0.2% and third year is 0.3%.
So on what basis are these projections made, Mr. Khan? Are you already in touch? Does this building already have some clients? What is the clientage looking like? What is the industry that they are coming from? This is built by Prestige, I believe. So is it already occupied, or you still have to sign some agreements with some of the lessors?
It is already occupied, but once we acquire the building, we will sign the lease with the tenant in our name. The building is occupied by a US-based IT company with 15,000 plus employees. The building is on Outer Ring Road, Bangalore, which is the biggest office market in Bangalore, built by the Prestige Group, one of the largest developers in India. The building itself is within a big multinational tenanted park with tenants like JP Morgan, Adobe, Oracle, etc. And a lot of the buildings within the park are institutionally owned.
Okay. So, you know, in FY28, you're expecting an increase in your net operating income. Can you give us a sense of what would lead to this, and what would the typical EBITDA margins be in a small REIT versus the other REITs that are already listed, the larger REITs that is?
Yeah, so the rents typically in commercial leases increase either every year or every 3 years. In this case, after 3 years, the rent would go to 107 rupees from 103. And after 6 years, it would be 123 rupees. So these are inflation linked. The rent increases and therefore the distribution also increases. Typically, the way investors should evaluate this is the distribution yield. If they invest 100 rupees, they should expect to get 9 rupees every year as distribution income. Pre-tax, post-tax, it would be 8.2.
Okay. All right, Mr. Khan, thank you so much for joining in and explaining us the structure and how you would go about this REIT. And this is first of a kind, so it will be interesting to see the traction and the response as well. That's the word coming in from the REIT. This is Property Share REIT IPO, which opens for subscription today. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that.
A very happy birthday to the entire team at CNBC-TV18. Congratulations. Well, I've had many fond memories of Shireen and others talking to me during the pandemic and having a very close discussion on how we, brought India back out of the pandemic much faster than most other countries in terms of economic recovery, in terms of protecting, all our citizens. And of course, some of the fond memories when I received the Business Leader Award from you 2 years ago. That was a very nice, cherished moment for me. So these are some of the memories.
Welcome back. So MapMy India is under pressure. The stock is down close to about 3.5%, and there are two key reasons for that. One, the company's promoter, the son. So basically, Rohan Verma, who currently is the MD and CEO of MapMy India, is now floating a new venture. So he's going to resign from his executive responsibilities of MapMy India, and he's starting a new B2C operations. Remember, MapMy India is known largely for its B2B, but they want to focus on B2C. It requires investments, it requires capital, and it will require a lot of focus. So this new B2C business will be held by, led by Rohan Verma. So the two reasons why the stock is down, one, because Rohan Verma was involved with MapMy India. He's not going to be involved except as as a non-executive, in the non-executive capacity. That's reason number one. And two, because of perhaps related party transactions. So the way the new venture is going to be structured is Rohan Verma will hold 90% in his personal capacity, and the balance 10% will be held by CE MapMy India or CE Info System. And to acquire this balance 10%, MapMy India will be investing 35 crores via a CCD. So those are the two key reasons why today the stock is under pressure, though the company has said that there is no issue related to related party. It's been done completely at an arm's length and in a very fair manner. But, there is always some concern on that front. And also the fact that Rohan Verma will be stepping down, from his executive responsibilities at CE Info Systems. The company is holding a conference call today at 5 p.m. So we will get greater clarity. But with that, we're going to wrap up on Trading Hour. We leave you with the news that it's flat on the Nifty and the Sensex. So it's been a quiet morning so far, but the action is in the mid-cap space. The mid-cap index is up nearly 0.5%, and the Nifty bank is down 250 points. Thank you for watching the show.